Hey, what's up, stock compounders? Brad here. So we're going to do another Mohnish Pabrai Q&A highlights video. Okay, this one was done in mid-July at the Value School Summer Summit. Sounds like these guys had a role in helping translate the Dando investor into Spanish. So that was a pretty cool nugget to pick up here. So here it is. Let's dive into the highlights from this Q&A at Value School. So Pabrai has asked, few investors have actually run a business. How important is it to be an entrepreneur as an investor? So Pabrai responds, I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. And that's a quote from Warren Buffett. The second piece of this, how can you explain to a fish what it is like to walk on land? Okay. Investing is really about understanding businesses. And it's really hard to understand businesses if you've never kind of worked from the inside out on a business, if you've never built a business. People who haven't built businesses tend to look at businesses using spreadsheets, right? They try to break everything down into numbers on spreadsheets. People who are actually running businesses, entrepreneurs, they usually don't operate from spreadsheets, right? They have 3 or 4 key metrics that they track, they really know by heart, and those are the only things that are going to move the needle for that business. You don't need, 100 entries into a spreadsheet in order to figure out how the business is doing. Pabrai says you can't look at businesses through spreadsheets. 3 or 4 key variables drive the outcome. It's hard to get to those variables if you haven't been in the driver's seat, okay? If you haven't run a business yourself. Pabrai is a bit confused when he comes across investors who haven't run a business themselves. Again, it's like, how do you explain to a fish what it's like to walk on land? He's asked about investing in different countries. He says you cannot paint a country with a wide brush that's one color. Okay, so people paint China with the CCP crackdown brush, Turkey with what's happening with the currency there, inflation, but there's nuances. There's many nuances when you dig into individual countries. There are great teams/businesses inside the chaos that can transcend country scale issues. Okay. That's really what Pabrai was able to find with Prosus in Turkey. In Korea, he owns Nice Holdings. I assume it's a similar situation there. So it's interesting how many countries he's invested in and how much work it must take to really kind of dig down into the details of the environment that each of those businesses operate in. He says, when he invests in countries outside of the U.S., he visits management, right? Because he really needs to kick the tires. He needs to see that the assets on the balance sheet are actually real, right? These things exist. Because there's a lot more fraud when you get outside of the developed world. Let's see. He's asked about China. Obviously, Alibaba, Tencent, Pabrai has been talking a lot about lately. He says most of China is off limits to me. He just can't understand it, right? There's a small sliver that he can understand. Tencent and Alibaba, very early on in those businesses, they had Western investors, right? They happen to be based in China, but they're multinational in their views. Non-Chinese infusion into their DNA. So Pabrai thinks that he can really sink his teeth into Tencent and Alibaba for some of those reasons. He's asked about 2020, right? The big year of learning, his second biggest year of learning after his first year in 1994, just devouring Buffett and Peter Lynch and other great investors. 2020. He said 2020 is like adding 4 to 5 knives to the Swiss Army knife. Okay, there's more tools that he has in his belt now. In the 1990s, Pabrai saw the power of having capital light, high return on equity tech businesses and what they could do in terms of scale and growth. Okay, a lot of people think Pabrai started out kind of in the Graham framework with a sharp focus on the downside, and the upside would take care of itself. But he was actually pretty heavily invested in some tech companies, right? He had a couple hundred baggers in the late 90s, and those were in tech. When Pabrai Funds started in mid-99, so this is after he's done 4 or 5 years of personal investing at this point. He starts Pabrai Funds in mid-99. He started to see the warning signs, okay, that things were getting out of control. There's a bubble in tech. There's lots of euphoria. It didn't look sustainable. So with Pabrai Funds, he sidestepped the bubble. And he only was able to see a few months ahead of everyone else that the bubble, the end of the bubble was near. And that's all it took. He told Microsoft employees in 2000, right? He visited Microsoft because he wanted to find more investors for his fund. And he knew someone who worked at Microsoft, and they introduced him to some of their peers that also worked at Microsoft. So he visited, and he told the employees there that Microsoft is a great business, but it's a bad investment, okay? It was trading at 60 to 70 times earnings. And that panned out. Obviously a great business. I mean, look at what Microsoft has done, where it is now in terms of, atop the tech businesses of the world. But from 2000 to 2016, the stock was flat. Okay, so if you had bought at the peak in 2000, it took 16 years to get back to where you were in 2000. And it'd be a roller coaster ride, right? It wasn't a flat 16 years. It was quite turbulent. So it would have been very hard to hold on for those 16 years. Pabrai switched to Graham in 1999 because he wanted the downside protection. And this really reminds me of what Howard Marks talks about, trying to get a sense for where we are in market cycles. And the reason for that, and there's no precision to it, but you can know, if you're looking for it, are we closer to the bubble end, or are we closer to the bottom end? And if we know that, we can focus either on downside protection for near the bubble end, or we can focus on, growth if we're kind of near the bottom end. So that's the switch that Pabrai made in 1999. Focus on downside protection. Look at not losing money first and foremost, and then the rest would take care of itself. So he went from a growth tech investor to a Graham investor. He says he should have switched back in 2013 or 2014, okay, but he forgot. It was in his nature now to look for these Graham-type investments. He was just so used to it after 14 years. He says the best way to invest is to own a stock in a business which generates high returns on capital and has a long growth runway ahead, run by great management. Okay, those 3 key points. Nick Sleep started out as a deep value investor. So Nick Sleep, obviously the guy that really inspired Pabrai in 2020 to kind of shift around some of his investment framework. Nick Sleep started out as a deep value investor. Okay, he bought Zimbabwe Cement. Okay, if you read Nick Sleep's letters, this was one of the first companies that Nick Sleep bought, Zimbabwe Cement, trading at less than 1 PE ratio, less than 1. He evolved to Amazon and understanding nuances of scaled economies, shared businesses. Obviously, scaled economies, shared businesses. You've got Costco, you've got Amazon, you've got, what is it in London? Asus. He overdosed on Graham for a long time. This is Pabrai. Overdosed on Graham for a long time. Ready to overdose on Munger. Sometimes, so this is where the magic happens. If you can find incredible deep value investments that do better than great compounders, okay? Most of the time, great compounders will do the best. And then a little bit later, Pabrai gets into, the ideal, right? The ideal is if you can find something that's deeply, undervalued, that's also a great compounder. And this is what Pabrai found in Turkey with Prosus. It was like a 21 million market cap, or maybe 19 million, with assets worth 500 million. Okay. And of course, the assets have grown in value since then, along with the market cap. He's asked, do you have to switch hats when you're looking at low PEs versus compounders, these different knives in the Swiss Army knife? It's a very similar model. With the low PEs, with the gram, I put out $1 today and, figure out what am I getting in 5 to 10 years. No. In the gram approach, you're buying $1 for 50 cents, okay, and you're waiting for those to converge. All right, that's typically what value investors are looking for. Buy at a discount, wait until the market realizes, the underlying intrinsic value of the business. In the Munger method, you're putting out $1, but the dollar is increasing in value over time, okay? It's that rate of increase and how long it takes. So they're not that different. They're just, slightly different ways of looking at, putting out a bird. A bird in the hand is worth two in the bush, right? That old Buffett quote. Right, he talks about how it's orgasmic when the two worlds meet. But you could find a deep value combined with a long-term compounder. And you only need that to happen a few times in a lifetime, which is why I'm so excited to be following Mohnish Pabrai. Please, Pabrai, find a few more of these that aren't in Turkey, aren't in Korea, aren't in India, are in countries where I can actually participate in these equity investments. And I'm sure I could if I tried hard enough in India and Turkey. I just haven't made that effort yet. Okay, what do you think about current valuations, right? Everyone sees the market as being a bit frothy, or a lot of people do anyway. Are we in a bubble? Should we wait for a crash? That whole thing. Is it worth waiting for the next downturn? So Pabrai says the 10 baggers are few and far between. It's difficult to find these in any market, right? It's a treasure hunt. 10 baggers aren't just going to land at your feet. He's not a market timer. Pabrai talks about this all the time. He's looking for individual businesses where he can find that discount or that great long-term runway ahead. There are undervalued businesses all the time, right? Geographies and industries change. Human psychology goes up and down, both geographically and in industries. There's always stuff that's going to be thrown out by the market. He recommends the book Trend Watching by Ron and Sana. I haven't read this one, but it chronicles a wide number of bubbles, and it really highlighted to Pabrai that bubbles are happening all the time, right? Bubbles really just displaying human nature, okay? There's no hiding from human nature. It's going to pop up constantly. And, this vacillation between fear and greed is human nature, and that's what shows up in bubbles and crashes. Usually it's difficult to tell when you're in a bubble, all right? The bubble doesn't just scream at you, hey, this is a bubble, get out. The crash is near. Some things in my mind are clearly bubble-esque. All right, this is Pabrai, GameStop, AMC, Bitcoin. Okay, he sees those quite clearly in a bubble. It doesn't matter if he's right or wrong on any of those, right? Bitcoin, AMC, GameStop. It only matters that he's right on things that are in the portfolio. Okay, and this is Such an important point. So many of us investors spend so much effort, digging into these things that are never going to be in the portfolio, right? They're never going to be something we can fully understand or something that's compelling as an investment. Pabrai, it doesn't matter. It's really just entertainment for Pabrai to be keeping up with GameStop and Bitcoin and that kind of thing. We are not in value territory with large US tech or large Chinese tech. Those are really exceptional businesses, but you have to pay up to own those businesses, right? We're talking about Amazon, Google, Tencent, Alibaba, Microsoft. They're not in bubble territory. A company can face a headwind, which is very temporary, and the market takes it out back and shoots it. You should pay attention to that, okay? That can happen anytime, in any sector, in any country, where the market takes it out back and shoots it. And that's where we get interested. When, the market has sent the price a lot lower than, what would rationally, what the underlying business is worth in a rational kind of analysis. And that's just human psychology, human emotion, driving those prices, sometimes much lower, sometimes much higher than what can be rationally justified by the business fundamentals. So he's asked about when Buffett was running smaller amounts of capital. He said he could generate 50% annual returns. So Pabrai, of course, talks about that a bit. Warren is very different from us in the sense that very few people would have the intensity of pursuit of value that Warren Buffett has. He used to go through the Moody's manual looking for bargains, right? Pabrai bought some Moody's manuals from the 1950s on eBay just for nostalgia. There's 4 to 5 companies on each page with thousands of pages. So I actually followed Pabrai's footsteps on that. I bought a Moody's manual. This is a 1957 transportation company Moody's manual. How many pages are in this? 1,480 pages, okay? Incredibly small text, right? So Buffett would spend 14, 15 hours each day going through each page of these Moody's manuals. I think he did it several times for each one. That intensity of pursuit, when you have that, when your sole focus is to find these opportunities that other investors have missed, it's going to happen for you. But not many people have that intensity of pursuit. 50% a year is definitely possible running a small amount of capital following a Graham approach, but one needs to be very dogged about it, right? We just kind of covered that. Warren went through those Moody's manuals at least a couple times. Would not have had a problem sitting down and going through 20,000 stocks at a time. Happy sitting there from 7 a.m. to midnight every day, spending a few minutes on each company. Okay, this kind of gives you insight into how seriously, how singularly focused Warren Buffett was on this. If you have a temperament like that, where you can focus all of your attention for prolonged periods of time, then it's going to happen for you, okay? Extreme patience with extreme ability to work hard and extreme action when you find no-brainers, okay? This is really the formula for success as an investor. Extreme patience, extreme ability to work hard, and extreme action when you find no-brainers, okay? Very extreme cubed there. Warren Buffett probably wouldn't have more than 3 stocks if he was running, say, $1 million or a couple $1 million. He would have 3 very high conviction bets. Warren used to say 15 to 20 years ago that 99% of his net worth was in Berkshire Hathaway. Okay, he doesn't say that anymore. The 1% that he had outside of Berkshire has grown significantly more than the compounding within Berkshire. Okay, and this really speaks to the advantage of running small amounts of capital and having so many more opportunities that can move the needle with smaller amounts of capital versus Berkshire, who's market cap of 600 billion or so. There really aren't that many companies out there that can move the needle for Berkshire Hathaway. So it's an interesting side note here from Pabrai about how, many times that 1% consisted of one stock. Okay, this 1% that Buffett had outside of Berkshire Hathaway that just compounded so much more quickly than the 99% that was in Berkshire recently. Talks about how 3 times in the last few decades, Berkshire has lost more than half of its value, and it didn't bother Warren and Charlie. Okay, this really speaks to the temperament. It speaks to psychological strength of Warren Buffett and Charlie Munger as it relates to investing. That really price doesn't influence them, at least in the way of making them question what the businesses they own are worth. Obviously, it influences them if the market is offering something really cheap, gives them an opportunity to buy, or if the market is offering ridiculously high prices for something, it gives them an opportunity to sell. But Warren and Charlie don't look at the market to tell them what something is worth. Okay, those are very separate things. Know what your portfolio is worth, not what the market is pricing it at. Okay, this is value investing 101. But it can be very hard to do, right? If you own a stock that's crashing, it can be very difficult to think to yourself, hey, maybe the market knows something that I don't. And that might actually be true. Okay, it's probably very prudent to really dig in and make sure you understand the business better than the market does. But at the end of the day, the market is this manic depressive thing, right? This herd of humans that can behave in very irrational ways. The two can diverge quite a bit, what your portfolio is worth and what the market is pricing it at. If you don't have leverage in the portfolio, big price drops are irrelevant. Okay, if you have leverage and the price crashes, you could get margin calls, right? Which is what happened to Warren Buffett and Charlie Munger had a business partner, Rick Guerin. And Rick was in a hurry to get rich. Okay, Warren and Charlie always knew that they were going to get rich, and they weren't in a hurry. Rick was in a hurry, and so he, leveraged his investments and had to sell Berkshire Hathaway back to Warren Buffett. I think it was like $40 a share, way back when. So, just a brutal outcome there. But if you don't have leverage in the portfolio, you can wait. You can wait. You have all the time in the world to wait until the market rationally prices what's in your portfolio. There's wide variance between price and the wide variance between price and value is the nature of auction-driven markets. Okay, it's why we have opportunities as investors, but it's easy for investors to make the mistake of letting that advantage, letting that opportunity work against us, thinking the market knows something we don't, and trusting the market to let us know by price action what we should do in the wrong way. Right, the overshooting and the undershooting helps us make money. Okay, if we have that anchor of knowing what the intrinsic business value is, if we have that compass to know where we're at, it can be incredibly profitable. Now, he's asked about Naspers and Prosus. Holding company discounts in equity markets are a very common occurrence, right? So, of course, Naspers has a very large discount from net asset value currently by the markets. Prosus has a pretty big discount as well. It's not as big as it is with Naspers. But Pabrai is asked about this discount for holding companies. And I really appreciated his response. And this was actually Koos Becker on a Naspers call responded in this way. If I own a Picasso worth 10 million and I own a Matisse, which is also worth 10 million, and I tell you that you can buy both from me, you may be a Picasso fan but not a Matisse fan. Or you may be a Matisse fan and not a Picasso fan. If both are shoved down your throat, right, you have to take both. You can't just buy one. You say, okay, for 15 million, I'll take both. And that's really, the analogy that Koos Becker is making for these holding companies. Like for example, with Naspers. Naspers owns a very large stake in Tencent, okay? And there's a lot of people who are interested in owning Tencent through Naspers because of that discount, but they aren't necessarily going to value the other assets owned by Naspers at market value, right? They want Tencent. They don't necessarily care about or understand these other assets within Naspers. So, they're not going to be willing to pay full price of net asset value for Naspers or Prosus. So let's say Prosus has 200 billion of Tencent and 40 billion of other investments, right? The current market value is under 150 billion, all right? So 240 billion net asset value, 150 billion is what the market is pricing Prosus at. Part of that discount is the Picasso Matisse issue. Some of the parts discounts are very common, and sometimes the market gives you things on a platter, and that can be great. And there's a lot of people interpreting that statement that, Prosus is being given to us on a platter, and that Pabrai probably went ahead and bought a stake in Prosus. Now, if he bought the over-the-counter U.S. security for Prosus, which is PROSY. We should see that in the 13F filings for Mohnish Pabrai, probably coming out tomorrow, either tomorrow or Monday. But if he bought on the Amsterdam exchange, if it's a 150 billion market cap company, we're not going to see Pabrai's ownership because Pabrai wouldn't be putting in more than 75 million, right? Assuming he has about 750 million in assets for Pabrai funds. He likes to make somewhere around 10% bets. He's not going to be putting more than 75 million into Prosus. So we're not going to see that if he goes through the Amsterdam exchange. But it's fun to speculate about. It's possible that he'll disclose to his shareholders in the Pabrai Fund's letters that he bought Prosus. And then, it can trickle down to us. So maybe we'll see it that way if he did in fact do that. But we just have no way of knowing at this point. But I'm very excited to see Pabrai's 13Fs out, hopefully tomorrow, if not on Monday. And I'll be doing a lot more videos on other super investors that I follow, what's happening in their 13Fs. So stay tuned for that. But also let me know in the comments, what is your biggest takeaway, highlight from Pabrai's Q&A with Value School Summer Summit from mid-July. So I know I'm a little bit late on this one. I was on vacation for 2 weeks. I'll try not to let it happen again. I like to just take a day or two, maybe 3, to turn around with these Q&As and share my highlights to help both drill it into my own head and help you guys out, drill these lessons into your heads as well. So anyway, without further ado, I will see you all in the next video. Take care.